We've seen a great transformation of the senior debt market in Europe over the last 5 years. Initially, just after the crisis, investors invested in sovereign debt, investment-grade debt. But as spread compressed in these asset classes, investors moved toward senior loans. And this is perfectly understandable, as investors will find in this asset class, first, a senior position in the capital structure from a risk perspective, in particular because leverage of LBO transaction is much lower these days than it was pre-crisis, but also investors benefit from an edge against interest rate rise because these loans are typically paying Euribor plus margin. And third point, the margin that these investors will get today is significantly higher than it was 3 or 4 years ago. Before the crisis, these loans were paying 250, 300 basis points. These days, these loans pay about 450 basis points. Thanks to the margin of 450, 500 basis points over Euribor, senior secured loan in today's market provide yield which is very comparable to high-yield bond. But senior loans have a very attractive feature, in fact more than one, attractive features versus high-yield bonds because they are senior secured, they are really at the top of the capital structure versus high-yield bonds which are often in a more junior position, but also being floating rate, they will provide the investors against any interest rate rise, while the high-yield bond asset class may suffer from a value perspective from such an increase. To give you an example, more than 200 issuers have issued senior secured loan in Europe over the last 18 months. So it's wide enough to allow asset managers to create very diversified portfolios. In spite of this very interesting characteristic of the loan asset class, we don't expect the demand to outpace the offer and to reduce spread because the natural buyers of this asset class, the CLOs, are getting less and less active in the asset class, while the demand for the new investors, which come from insurance companies, pension funds, foundations, is not as large as the diminishing demand from CLOs. So we expect the margin on the asset class to stay at the level we see today at about 450 basis points, making this asset class an extremely attractive asset class on the long term for institutional investors.